Hi everyone, so today I'm with Dom and we are going to be covering KKR. This is going to act as a stock analysis video. So Dom, whenever you're ready, please take it away.
All right, can you see my screen?
Yeah, perfect.
Awesome. So we're just going to go over KKR really quick, kind of just talk about, what they do and how they make money, and then I'll transition and kind of talk about their financial results in the latest quarter. So first thing to know about them is they are a global investment firm investing across private markets and every asset class across the world. They say their mission is to fortify companies and communities and help secure futures of institutions and individuals counting on us. Some nice little marketing right there to say we give you money to do things. All right, so moving on, they have four main kind of like era sections that they classify for their investing. So first is institutional investors. So they say they differentiate in investment insights, time tested approach, and wide array of solutions to help pensions, sovereign wealth funds, endowments, foundations, consultant, and insurance companies fulfill their missions. They also mentioned family capital. It says they help to fulfill global family capital team is dedicated to helping families and entrepreneurs find solutions to unique investment needs. Global wealth, they say they help to provide solutions for individual investors across private equity, private credit, infrastructure, real estate draw on investment processes honed over nearly 5 decades in many market cycles. And finally, they have the section companies, and they say they invest in companies to benefit from more than just the capital. As a trusted partner, they aim to help achieve operational excellence and provide expertise across a variety of industries and markets. So basically, any main area you think you can get an investment in, they most likely will have dipped their toes. So let's jump into their earnings. So here we have Q3 2025. And just want to remind everyone, because they are like a venture, like an investment type of firm, most of the like money stuff we're going to see is all going to be like fee related because it's not like a true company because they invest their money and they get fees and things like that back as their revenue. So knowing that, let's jump into it. So first thing, fee-related earnings are $1.15 per share. Total operating earnings $1.55 per share. Adjusted net income is $1.41 per share. Management fees $1.1 billion, up 19% year over year. Not bad, good amount. Transaction and monitoring fees $328 million. Capital market fees $276 million. Fee-related performance revenues $73 million, up 30% year over year. Good to see. Well, if you're not the person paying the fee, it's not good. But if you're investing in them, it's nice to see. Fee-related compensation, 17.5% of guided range. Other operating expenses, 176 million. They have insurance segment operating earnings at 305 million. Strategic holding operation earnings, 58 million. Realized performance and investment income, 935 million. Net realized investment income, they have that strategic holdings is at 70 mil. Adjusted net income, 1.3 billion, up 8% year over year. Capital raise 43 billion in Q3, second highest fundraising quarter in history. Not bad at all. Organic new capital raise, they say credit platform, 60% of 43 billion. Inflows of Global Atlantic, 15 billion. Private equity and real estate capital raised, 16 billion. K-series product inflows, 4.1 billion, up 20% from last quarter. Capital invested, 26 billion in Q3. Dry powder available, 126 billion. Embedded gains 17 billion across asset management and strategic holdings. Total insurance economics year to date approximately 1.4 billion net of compensation, up 16% year over year. K Series AUM 32 billion, up 15 billion from a year ago. Not bad, not bad at all. Expected monetizations 800 million over the next 2 quarters. And then finally, they have embedded gains across firm, 17 billion, second highest in history. So I
Okay.
would say pretty good. We don't cover too many of these types of companies on the channel, but I would say definitely for year over year fees and other aspects, very good. Um, so we'll see how that kind of takes a impact on their financials as Matt looks into that. So let's
Okay.
switch over to him and see how all of that looks.
All right. Thank you, Dom. I appreciate it.
Yep.
All right. So Dom was saying, the companies I would say okay, and this is going to actually be reflected in Simply Wall Street. Simply Wall Street is going to be currently 5 billion in free cash flow, and the next 3 years is going to be 9.9 billion. So you're very close to a double. It's not quite. It's like a 1.95x. So pretty close, but not quite there. Keep in mind though, they've had quite a rally the past couple of years. They're up like 200%. They're doing very well altogether. So just keep that in mind. The financial health of the company here, you need to be a little bit cautious of, but again, this is their nature of the business. They're always going to just have a significant amount of debt because they are a private equity firm and they just naturally carry a lot of debt. So you have a lot of equity, debt's in the middle, and you have cash. It's rising, but still, the debt's still quite high. So you do need to be a little bit careful of that. Now, the current DCF that I have, it is 26% undervalued. That's based off historical. When we check Wall Street forecast, Wall Street's going to be undervalued by 8%. So yeah, it's still undervalued. They've had quite a rally, so you need to keep that in mind. There might not be so much wiggle room to grow here. And I want to add a new segment with Dom. And what we're going to add is to cover the low and the high of the company. So right now, the stock is trading $130 a share. This is just a year. The 52-week low is $86, and the 52-week high is $170. So you probably would want, in this case, in this scenario for them, you probably would want for them to drop a little bit more to closer, obviously, to the 86 mark. I know they've had a little bit of a drawdown the past year. You could even see that they're down 8%, and they've been continuing to climb down. So I would definitely keep an eye out on that to get as close to that 52-week low as possible. And lastly, what we're going to take a look at is, of course, Tipranks. And Tipranks is going to say that it is a 22% upside on it. You have strong buy, 9 buys, low of 145, an average of 158, and a high of 174. I mean, yeah, I understand where they're coming from. I think it's a good company. Of course, it's KKR. They're massive. They're like the preeminent private equity firm. But just to be on the safe side, I'd probably want to wait for a little bit more of a drawdown on the stock. Dom, is there anything else you wanted to add?
Uh, no, I don't think there's anything else I can put on this one.
Okay. All right. Thank you, everyone. Thank you, Dom.
Thank you.